Happy holidays, everybody. All right, it is December 2022, and this is Quiver Financial's 2022 market recap, and I'm joined here with Patrick Moorhead, Justin Singletary, and we haven't hit the eggnog yet, but we're getting ready to. And Santa, how are you? It's been a while. I'm glad you were able to join us. It's been a year since Santa joined us. And in today's event, we have something we put together for you because this is actually one of the first years that we've had all of the past events and what we talked about as far as forecasts in the market and our updates all recorded. So we went back through about 8 hours of different video, spliced it and diced it, and gave you guys the highlights of 2022 from January, or actually December of last year, all the way up to our last event in September, giving you an update on what's happened in the equity market, interest rates, currencies, and commodities. And so at the very end of this video that we put together of all the highlights, we're going to then do a little rapid fire of what we think 2023 holds for investors in those 5 asset categories. So gentlemen, without any further ado, let's jump into this video for now. And we do this each quarter as a way to communicate to our clients and anybody who's interested in becoming a client what we're seeing markets doing and what we're forecasting the moves that we could make. Our structure is very simple. We narrow things down to 5 categories because if you think about it, your net worth is controlled by 5 major asset classes. It's like the dollar is the one investment category that just totally gets forgotten. It's like peas in a dinner, right? The dollar is peas and carrots or something. Like gold is carrots and peas is the dollar. But it's really, really, really important to pay attention to because the U.S. dollar, it controls all kinds of cash flow around the whole globe. And so it's a really good tell. Like an EKG, where you can just by understanding how those little wiggles work, you can get an understanding of how the different valves in the heart are pumping. So the dollar really gives us good insight on the internals. And what we had shared back in November, and what it's bottoming against is the price of other global currencies, like the dollar compared to the euro, or the dollar compared to the Japanese yen. So let's get into the equity market, and then we'll open this up for questions and answers. The equity market is what everybody cares about, and that's why we leave it for the last. I always have to remind people that you got to think broader and bigger than just one thing, because sometimes that one thing doesn't work, and it's rare, but it happens. And this is what we call a 100-year channel, basically. So there's only been once before the Great Depression that we've tapped the high point of this channel. Behavior is typically after you do that, you get some kind of contraction. For the last 3, 4, 5, 6, 10, a while, folks, we've been talking about these wave counts. And to refresh your memory, bull markets will grow in 5 waves, and then they will have 3-wave contractions to kind of correct and buy time before the next leg higher. In the midst of COVID, when everybody was extremely negative, right about this level, we said, hey, wait a second, this might be the end of the 4th wave. We got to be aware, because remember, April, May, June of last year, what were we doing? We were hunkered down. We were hoarding our toilet paper. We were telling nobody come over, or if you do, knock twice, otherwise I'm going to shoot you through the door. So there's all kinds of crazy crap going around. 5th waves are the ending wave because they run out of steam, like anything does going up a hill. So now we're experiencing it in real life, like what could cause a market to really explode higher and then lose steam? Holy shit, a pandemic, right? So all of a sudden, this 5th wave has just been climbing. And folks, it ain't normal for a market to go from 2,500 to 4,500. Okay, that's almost a double. right? So if you got neighbors who are like, we're making so much money, remind them, hey, the last time that the stock market doubled in a year was never. Okay, yeah. With rising inflation, the recent spike in food and gas prices, and the conflict in Ukraine weighing heavy on markets, many investors are wondering what to expect next in the stock market, interest rates, and commodities. And we tend to see dollar strength in recessions as well as in global crisis. It's counterintuitive. It just happens. I won't go into the details of all the reasons why, but that's what happens until the printing press goes brrr. I think what we end up doing is we kind of backfill here, keep kind of testing this area of support. Eventually, we work our way up to that red line and get above it. Since the beginning of the year, there's really been a trend change here. So the S&P 500, as of today, as of this morning, at the end of the day, it was down another 1 or 2%. So right around here at the end of March, into the first quarter, S&P 500 is down roughly 5%. Now, 7 days ago, folks, this thing was down 10%. So you can see there's some serious volatility swinging around here. The NASDAQ is down about 10% year to date. 7 days ago, a week ago, if we did this event, the market was down 19, or the NASDAQ was down 19%. We have this 5-wave decline. So 1, 2, 3, 4, 5. And we had said there, we got a 5-wave decline. I didn't draw this, but there's a trend line that goes right through here that we broke, okay, and then tested it and came back down. So that checks off that first thing, 5-wave decline, breaks trend line, retests, fails, right? But ultimately, this usually fails and you go much lower. This behavior fits everything. You 5-wave decline, break the trend line, 3-wave rally. So the next 2-3 weeks is really key. Middle of April, end of April, we'll really have a big update, because if this fails and goes down, man, are we, Patrick, Justin, if this happens, folks, you better tell everybody about it. You better call all your friends, call all your family, and say, I found the best friggin' money managers ever, because they're the only ones that told us about this.
And you might say to yourself, well, man, that seems cheap. It's cut in half. What a great time to get in. Don't be caught flat-footed with that.
And now, if I bring us up to current time, what you will see is that interest rates have spiked out. They've really gone up above that line. And so now we have to assume that going forward, we're probably now trading in a new range. So I'd be willing to bet that a good portion of the recent interest rate move that we've seen is a global marketplace, and it's a little bit of financial warfare that we're experiencing.
But to your point of, treasury bonds in themselves during a rising interest rate is not something we're going to want to be holding, because exactly what you said, between foreign investors and a federal government ourselves, we own over 3/4 of all the bonds, treasury bills out there. So the Fed has already said that they're going to taper back. So we just lost our support in that aspect of it.
I would only add that, based on everything and where we are in the cycles and everything, that cash is probably one of the more important places just to protect principal versus trying to find something that might be able to, get you some growth or get you some yield.
Commodities and metals. So here's the thing. I want to discuss why and why not. Why commodities could be the growth component for a portfolio for the next, who knows, time frame. Are we in the 1970s? I'm feeling this way. Natural gas, boy, oh boy, oh boy. Natural gas, oil, all these things, craziness, right? This is another one of those triangle patterns. It's a little inverted, but nonetheless, if and when this thing gets above 20, this pattern looks pretty impressive. And so we've been able to benefit from it. I do think natural gas is one that's on a trend multi-year. This is something I want to add. This is something that I watched in the last big commodity boom. So this was like 07, 08 when we had this big boom. And this asset gets exposure to all the soft commodities out there. So it owns all the companies that are going to deal with any of the food stuff. But you've got this 5-wave bounce off this bottom. So this is something that I'm watching very carefully. You recently bought a diamond, so you might be talking your book. Justin comes on and goes, man, I'm really bullish on diamonds. I think everybody should buy diamonds. If you need one, I got one.
Since the end of March, equity and bond markets have continued to slide into negative territory, with the NASDAQ, the small cap indexes, and the S&P 500 all falling into officially bear market territory, which, if you didn't know, is down more than 20%. While the commodity complex, represented by oil, gas, and food commodities, has ripped higher by double digits, creating historically high inflation, putting global economies at risk of recession. Woo!
I'd like to ask the Quiver clients, are you happy with what we've been doing for you this past year? Are you happy with your account? Thank you. Thank you.
So how much further is the stock market going to fall, and will the decline end? Right now, it looks like we're working off of a high that lasted for 10 years, and now we're into this first mega wave of a bear market. So I'm expecting it to go 5 waves down. We've done 3. I think we get a little bit of a rally in the near term, maybe through the 4th of July. And then I think after that, we may get a new low. So that's what we're anticipating here. If you're short the market, the easy money's probably been made. Now it becomes a little more difficult.
Yep.
And if you're somebody who's been sitting on the sidelines waiting to buy the dip, but I would highly suggest there's a very big risk that this is a huge much bigger bear market than people are talking about. So if you are a buy the dipper, I would highly suggest that you do it in very, very small increments, what we call position sizing. Leave yourself a lot of extra cash. Bear markets, you do not want to take on too much risk too soon, because a lot of things are still at very high valuations. And, we've talked a lot about that.
Yeah, I don't think we've reached max pain yet.
Well, when interest rates go from 1.5 to 3, a lot of those low-risk investments become high-risk, and they're seeing even double-digit returns. I've seen things like U.S. Franklin Income Fund down 12, 14% at points in the year.
Right.
I mean, this is stuff like 90-year-old ladies own, right? I mean, talk about get your knickers in an uproar. So interest rates tend to trade in a range for long periods of time. That they tend to really trade in a range as we're figuring out where their true economy lies. So if you look at this chart here that goes back to 2013 of the 10-year Treasury, you can see that even though there's been a lot of hype around interest rates rising, we're really just at the same spot we were back in 2013, not much higher. So we've been trading sideways, and from 2013 to 2019, for 6 years, we basically traded between 1.5 and 3, just like we did recently. The difference is this happened fast, right? It happened really fast.
If we were to keep going, how much further?
Well, so right, it's a great question because I gave the downside, right? By looking at the chart, 4%, seems like that number, Like if the market if the market wanted to so now, and then on the other side, you have the biggest disappointment. I mean, the biggest disappointment since all of us were in high school is gold, right? Gold has done nothing, but hey, it hasn't lost you money. It's been flat. It's ripped up almost 50%. Natural gas, I mean, hey,
It's been on a tear.
if you want, we've been saying it a long time. If you want to play the electric car game, natural gas, right? And I haven't even put coal up there. I mean, talk about something nobody wanted to see happen. But nonetheless, food commodities up a third, up 30%. So I mean, this is inflation at its best, folks, and nobody's used to investing in these times.
I think we're all seeing it too in our pocketbook. I mean, everywhere you go, we go out to eat, everything's $20 or north of $20. You
It's
can't get
amazing.
anything less than spending $20 for a cheeseburger.
Yeah. Yeah. So what can we expect as the year progresses? I don't think the inflation story goes away. Obviously, you know, one thing we have to remember is that, you know, inflation usually is the cause of recession. You know, the goal of the market is to create maximum frustration to the maximum number of people. My best mentor told me I was probably 5 days in the job, and he said, Colby, you want to know how to make money? Find whatever company is screwing you and invest in them.
We position it so that we're nimble enough that if the charts tell us something different, you know, after we've been in there, we can adapt and change.
Yeah, pivot, yeah.
That's why we use 5 asset classes. Welcome, everyone, to Quiver Financial's Taming the 2022 Bear Market. This is our third episode because it's the end of the third quarter. And we do this each quarter as a way to communicate to our clients and anybody who's interested in becoming a client what we're seeing markets doing and what we're forecasting the moves that we could make. Our structure is very simple. We narrow things down to 5 categories because if you think about it, your net worth is controlled by 5 major asset classes.
Kind of counterintuitive considering the dollar just keeps going higher.
Oh, it's so strong. Wait till you see the charts in a few slides. The dollar is amazing right now. This is a chart going back to 2019 that we shared in June to show that really since the pandemic bottom, the dollar's had a lot of strength. I was thinking we had this little 5-wave rally that was coming into resistance. Last time in June, I thought the dollar was going to take a decent pullback, you know, and we were wrong. And if you ever want to be wrong,
Had the signs there.
yeah, if you ever want to be wrong, this is the best way to be wrong, because where you're wrong is you're expecting an
One
asset
thing,
to
yep.
decline. And if you go to the next slide, thank God we were wrong, because it, rather than declining off of that line of resistance, it just powered through it. I mean, it just boom, you know, just right through the line. And so that changes my perspective. What the heck is going on in the stock market? That's what everybody wants to know, and we're going to get into that. But holy cow, what a widowmaker this market has become. I mean, there are a lot of widows and a lot of children that are going to get their inheritance a lot earlier with this stock market volatility going on. Yeah, I mean, listen, if you're a baby boomer and your attitude right now is, you know, in 2008, I lost half my 401k portfolio value, but big deal, it came back, right? Okay, fine. Now, you know, do you have 10 more years to wait around? You know, in bear markets, that you tend to end the week on the lows. We had said, yeah, you know, we're probably coming into the zone. We should expect a bounce, at least a bear market rally. And if you go to the next slide, you'll see what's happened since then. So where that 3 is basically the end of June. That red line is the red line we had on the last slide. And one of 2 things is going to happen is markets love to create maximum frustration. So right now, attitudes are, after Friday, we're crashing. We're going lower. You know, Justin, you had pointed out the options
Yeah,
markets.
I was going to bring that up, yeah.
So, you know, people would expect a crash, and if the market wants to create maximum frustration, maybe it could reverse course here and make another run higher. That's a big if.
Yeah, I was going to say that the options market is definitely ripe for a short squeeze.
I don't think sentiment has really hit to cause that knife to go straight through down to 34, 3,300 down pre-COVID or pandemic levels. So I'm leaning more towards the bounce.
I think the end result is the market's going lower. It's
Overall,
just does it go lower now or does it go lower later? This is when people learn that why do I need 15 mutual funds that I'll own the same stocks? That this is why 5 asset classes matters, because you focus on reducing correlation.
Right.
Everybody else in the business is diversify. Well, what the hell good is that if all of them are going down?
Right.
Like if the tide's going lower, I don't want to be in a boat. I want to be in a plane. Well, and here's the thing is, you got oil up 17%. Now in June, in our last video, I think it was up like close to 70. So it's come down quite a bit from that peak. Natural gas was it was like a double and a half at some point. So it's had a big correction, and food commodities were up about 30% back then. Yep. So, when you hear about the inflation story, you can see since June, there's been a tail off at least in the commodity prices. So
I think you're overlooking the gold. I think the fact that gold is down 10% in an inflationary environment like we've been having is unheard of. Like historically, that just doesn't happen.
We said it in our last thing. Gold has been the biggest disappointment since all of us to our parents in high school. So gold will move when the Fed stops tightening.
Warren Buffett said it best, rule number 1, never lose money. So, even if you're in the younger years and you have the time to come back, your portfolio benefits so much more if you just don't lose the money during a down period.
People don't realize how important the dollar is to the rest of their portfolio. Everybody looks at stocks and bonds. That's like the tail, right? The stocks and bonds are the tail. If you want to know what the dog is wagging the tail, it's currencies, it's interest rates. So most people are looking at the wrong thing when they start to build their portfolio, and that's why when you get into a bear market, everybody loses money. First thing is always, are you in a bull market or bear market? And then from there, once you have that decision and we decide bear market, then you just have to assume that all surprises will be to the downside. Whatever made you money the last 10 years, whatever made you rich the last 10 years is probably not going to be the same vehicles that accumulate your wealth in the future. And you should never build your investment portfolio or your investment thesis around systemic. It'd be you should never build your investment thesis around things that happen once every 30 years. Yeah. Right. You build your investment thesis around what happens every 3 out of 5 days.
Right.
Well, gentlemen, I think we gave people some pretty good non-investment advice there, didn't we? Well, that's the 2022 year in a recap, which brings us right up to current time and the popular questions that most investors have, like what's going on in the stock market? Is it going to continue to rally higher after that June bottom, or is it going to go lower? What's going on in currencies? Does the dollar continue to defy gravity? And if it does, what does that mean for the stock market? What does that mean for other asset classes? Because it has an effect. And same thing with interest rates is now everybody's wondering, okay, we got to just over 4%, as Justin had asked in the video, how high could we go? We mentioned 4%. We got to 4.2 about a week and a half ago. And now we've pulled back. So now the big question is that the move? Is the Fed done? It doesn't sound like they are. Are interest rates going higher? And if so, how does that affect people's portfolios? What do they do? I feel bad for anybody who has a adjustable rate mortgage or anything like that, and if they're having that kind of concern. But what do you do with your cash now that rates are rising? What do you do with your risk assets? So those are all the questions that have come up. So guys, tell me, after watching that, out of 2022, what do you think is the biggest takeaway that you guys experienced? Like what was the biggest thing that pops in your mind?
Well, I think the last comment, one of the last comments that you made that we need to emphasize is that what's made you the money the last 10 years are not going to be the stocks that are going to march forward after this next recession. It happened in 2002, 2008, the ones that have rallied before. So you need to be, as we said in the video, nimble to be able to adapt to that aspect and not assume that what made you the money is going to continue going forward.
Yeah, this is where the psychologists would say recency bias.
Right.
So if you have a bias of what's been happening in the recent past and you think it's going to continue forward, it's a really good time to sit back and meditate on that.
Yeah, mine's been gold. Gold is just really kind of, up until recently, has just been, like we talked about, dead money. And for everything that's been going on, you'd think that it would have been rising, especially at the beginning part of the year.
Yeah, it's very common for most people to think that during inflationary times you want to hold gold. There's different types of inflationary times, and it's really not about inflationary times that gold performs. It's really about what's going on in currencies, what's going on in fear levels. There's a whole other factors there. And the charts of gold, and we'll get to that in a second, do look like there's a turn. There's something that, even though it's been a disappointment to people up to this point, something looks interesting in the charts. So let's wrap up. We got 10 minutes. And in that 10 minutes, what I want to do is be able to just give people an idea of what we are looking out as we look forward in 2023. What could be happening in these 5 asset categories, and how could that affect people's portfolios, and what can they do? What can they do about it? So rapid fire. I heard a deep breath. You had something there.
Well, just that, I mean, you said it at the Clan event, and I really liked that you emphasized it too, that we're constantly making decisions without all the information.
Yes.
And it's why we do this quarterly, and why we're trying to let people know what we think at least the next 3 months are going to look like, but then we're going to have to reevaluate that going forward. And it's why we keep updating these charts and keep giving you the predictions, because we don't have all the information at the time, but we've been pretty spot on kind of so far. So
yeah, investing is no different than raising a family, running a business. You're constantly making decisions without all the information in front of you, and then you have to adjust in real time. That's why it's important that if you're going to give people advice about what to do with their money, that you follow through at least on a quarterly basis and have a conversation about, hey, this is what we thought was going to happen. Did it happen or not? And how did we adjust for surprises? And how did we stick to our game plan if it was part of our game plan? So here, as part of that here's the equity market, since that's the thing that everybody really wants to talk about. We were pretty early on the bear market call, and in June, we had talked about, and this is a chart of June, we had talked about that we were looking for the market to bounce. It's already circled. Thank you. Yeah. Justin, you can point that out again. Yeah, I thought your 2023 was going to be a stronger year of your Vanna White skills. So, and then in September, we updated it and said, hey, in June, we said we should expect a little bit of a bear market bounce or rally. September, when we went into the September event, it felt like the market was just going to crater, right? And we talked about how bear markets love to end on the lows on a Friday. Just like what happened here in December, this past Friday, on December, 9th? So all the behaviors of the equity market really match up. And so in September, man, everybody really thought the stock market was going lower. And we said, hey, if the market wants to do what it normally does, create maximum frustration, then it'll rally. And essentially, that's what's happened. We've had this complex rally. And back then, we said, you've got either another bounce coming and then a downside, or we go straight to the downside. And you guys pointed out in the options market and in sentiment that you expected a bounce. That was a dead-on call. Congratulations, gentlemen. Pat yourself on the back. And so now what? Now, throughout that time frame, where are we? So right here, I updated the chart to the earlier this week. I drew this line of demarcation. Because if this is truly, and this is all these are big ifs, but if this is a bear market bounce, that is going to fail somewhere around 4,100 on the S&P or maybe 4,400, then I believe that this line that we are resting on as of Friday's close becomes really important, because if Monday the market gaps down, we'll have 5 waves off of this little high here, which would give me the feeling that trend is changing. And I would expect a little reprieve, and then it's a basically pay me now or pay me later market if you're of bearish tilt. If your belief is you're in a bear market, then I think these are the viable potential patterns. And granted, there's a flip side to the coin. It could go higher, but this is what I would be looking for if I was really bearish and I was looking for a place to either reduce risk. Like if I was nervous in June, or if I was in a 401k that had gotten obliterated this year, and I was thinking about, hey, how do I take advantage of this recent rally? Those are the areas that I would be looking. Like I would be reducing risk based on what's happening there myself.
This one's I think a little bit harder to predict than the one in September, just because of coming into year end.
Yes.
There's many different possibilities that could kind of happen at this point. So it's not as clear of what the market could potentially do before year end.
Correct. Yeah, well, like we got at our client event, the question was, do we expect a Santa Claus rally? Because seasonally, you tend to have, a little bit of a rally. The big story, markets get volume in markets start to dry up as you get closer to the holidays. And the old adage is don't short a dull market, meaning that, dull markets with not a lot of volume tend to drift higher. There has been years, I think it was 2018, where the market just cratered all the way into
It's a 10% loss.
Yeah, 10% loss right into it was
Christmas
Eve. And then after that, it just rallied for months. So, there's...
Or you have tax cutting tax saving strategies that come into play and all that type of stuff.
I mean, do you guys, this is, but when it comes to equity, folks, like I said, I'm under the belief, and how we're operating our models is that we want to be equity light, because we do believe that if we're right in these patterns, and we can be wrong, but if we're right, that if the market has another leg lower and it isn't attached to a recession, I think the target on the S&P starts to become around 3,000, which is about 10, 12% lower than we are now. And if that next leg lower is coupled with a recession or a soft recession, like we had like a 2000 type of style recession, then maybe we get down to, my first target's 3,500, which is about 12% lower than where we are now. And if we're coupled with a recession, then my target becomes more like 2,800, 3,000 on the S&P. And that would be a place then I'd be looking for signs of hope. And I'd be looking for people to be capitulating, and I'd be looking for the signs of that, hey, maybe the buy the dippers can start to come back in. Maybe we can start to look for an investment, not a trade, that type of stuff. So that's what I'm thinking there.
I got a question around the generals, the big generals, the big companies. I don't know if, excuse me.
Sure.
I don't know if they've had as big of a sell-off yet. So we talked a little bit about it earlier in the year in Max Payne.
Yeah. Yeah. So what Justin's mentioning is in the when the bear market is really advanced, then what we call the generals, it's going to be the handful of stocks that have been holding the market up. It's been the Amazon. I mean, it's been Apple is probably the biggest key, and a lot of these are already down 20, 30%. However, they're not down like a lot of the high value names that are down 70, 80% at this point. So what's going on with the generals is the question. And I will tell you, Apple's the one that I've been watching, and Apple looks very weak. Like clients that own large positions in Apple that are concerned about giving up their gains, I'm watching that closer than anything else, because it looks weak. So I do think that if the generals break down, which it does look that could be the very case, then that's what drives the next leg lower. And there again, we'll need a week or two to figure it out, but we'll know by our next March event for sure.
Yeah.
Well, and that goes back to the original point of what made you money is not going to continue to make you money.
Say.
But Apple, you might get a false rally as China starts to open up too.
Sure.
So kind of keeping an eye out for that.
Sure. Yeah. But Apple's a big key to the S&P. So for equity investors, I'm going to tell you that our models, I know like I said, we're equity light. We're very selective to certain sectors like energy and things that we feel have a secular trend behind them. But outside of that, we're waiting for our opportunities there. Now, interest rates. So here's a chart of the 10-year Treasury. So we had a call hitting 4%. We've talked for years about how interest rates trade in a range, and that now we seem to be trying to find a new range, is what's happening here. And I think what happens next is we continue to see a little bit of a pullback in rates like we've had over the last 10 days or so. Maybe we get as low as 3%, which is where this last channel line where we broke out. That would be a usual suspect. And then from there, what I'm thinking is this wave off the bottom, like I can see here where you have one, you have two here, come on mouse, two, and then you have this big one up, like this 3, 4, 5. It's either that or this is a big third wave here, and then you go into a fifth. Regardless, it starts to make me feel that whatever pullback happens in interest rates is a temporary pullback, and then the next leg is higher towards 5, maybe even as high as 6%. So that makes mortgage interest interesting, and I hope that's not the case. But we have a Fed meeting. The Fed's not really they're slowing down a little bit, but I'll tell you the economic numbers over the last few weeks have slowed down, but they're not enough to make the Fed pause. And I've traveled a lot the last few months. People are out and about and spending, and they're still hitting the restaurant. And I hear there's slowdown. I get it. But the Fed needs to keep pushing things because the economy hasn't slowed down, I think, enough for the Fed's liking. So I'm afraid that fundamentally it looks like rates could go higher, and technically by the charts it looks that way too. Not in the next few weeks, but over the next few months, it's something I definitely want to keep my eye on.
Well, and even if they slow, they're still raising rates, which is going to have an impact on the 10 to go up anyway. So it's
Yeah, I agree.
But the biggest problem is for people who are conservative. Like we mentioned it in the video, that if you have a lot of government bond funds or bond-oriented, fixed income-oriented things that are interest rate sensitive, or real estate-based items that are interest rate sensitive, those are the things that you got to really examine your portfolio for, because those are the things more conservative investors go to. And we've said for many years there will come a point where what used to be conservative becomes high risk because of this change in interest rates. And we're there. We're now. It's here. It's now. And so for anybody who owns a lot of bond or fixed income assets sensitive to interest rates, in the next few weeks, you might have an opportunity to kind of reposition some of those things before what may become the next wave of pain. And that's not investment advice. It's just contact us and we'll tell you what you need to do for your personal situation. But I'd be very nervous for conservative investors that own interest rate sensitive investments. Let's put it that way.
Yeah, the bond funds, more and more of the fund, like mutual fund type situations.
Yeah, funds,
not the individual.
Even REITs, traded REITs, things of that nature. I just feel that you want to tread very lightly there because you might have much better buying opportunities later. Yeah. All right, so let's run into the dollar. The dollar's been the thing that's really made a lot of this change. We talk about it all the time. The dollar and the interest rates are dogs. Everything else are tails, meaning that the dog wags the tail. So the dollar has a huge effect on equities, has a huge effect on interest rates, has a huge effect on all kinds of things throughout the global economy. When you go into recessions, there tends to be, especially a global recession, there tends to be a lot of dollar demand. We've seen that in the charts. We've been bullish to the dollar. We should have been more bullish to the dollar on hindsight. And my perspective has changed in the sense that the waves that are happening in the dollar, I believe, are bigger. So I do believe that the pullback that the dollar has seen over the last couple months, month and a half, is coming to its tail end. And I do think that the dollar will bottom this pullback in the dollar will coincide with the peak in the equity market, and you'll have both of them continue this negative correlation where when the dollar starts moving back higher or equities start moving back lower, vice versa. So I do think we're going into this last leg of the dollar. If you're new to dollar investing, then I'd be cautious because realize it's been going on for a while. And if we're correct on this and there is another leg higher, it's going to be the tail end of the move. It's, the move's getting long in the tooth. So I'm still bullish the dollar, but I'm looking for an off ramp if there is another rally. And I think it coincides with also the markets getting weaker. So. And it's really hard to argue with the charts. I just feel like, the dollar's been the one thing for years that it's been very easy in the charts to read.
Well, and like you said, it coincides with equities because look at what the rally we've had has been the pullback in the dollar as well. So if we have a downturn in equities, the dollar's going to rally. Yeah. You got anything there, Justin? Or you
I think I'm good.
Yeah, you want to point out the dates or anything? Vanna? All right, so with the big effect there. So and this will be the tell. So the big question has been, you mentioned in the video, Patrick, that gold's been a disappointment. You mentioned, Justin, just now that, the big takeaway for you over the years that gold didn't perform. It's interesting. I think what will be the tell is if the dollar gains strength and gold can hold kind of the current level that it's at, or at least not break below this green line. So gold can totally come back down to this green line, back up to the red. That I wouldn't be shocked. If this could be a totally contracting pattern where it kind of bounces around in here, and if that's happening while the dollar's gaining strength, then my conviction around gold's probably going to get higher because this next move in the dollar, if we're right, if it's that strong, it should just pound gold in the sand. It just push it down and say, no, you're not moving anywhere. You're going to continue to be a disappointment. So if it can just trade sideways during dollar strength, that's going to give me a tell. It's going to say, wait a second, the people are sniffing, the institutional guys, the big money's sniffing something changing eventually, maybe 3 months down the road, 5 months, whatever it may be. So the dollar I'm really interested in because even in this sell-off, you can kind of see where the volume's kind of dried up in that sell-off. So it's on the radar, and I want to say that maybe it stops being a disappointment. I don't know.
I think it's going to be. I think next year is going to be a big year for it. That's my call.
All right, well, Justin's going bold.
Well, we don't have the Bitcoin that is going to affect us anymore.
Well,
so
the Bitcoin or the crypto.
Right.
Yeah.
Well, with China now, making that deal with the Saudi Arabia and the oil situation, I know that they've tapered on their interest, or their loans, and then they've been increasing in purchases of gold.
Yeah.
So you're going to start to see that big institution, that big nation start purchasing a lot of gold. So I think that's a good tailwind.
Yeah. Yeah. I'll believe in Bitcoin and crypto when I see the central banks of the world buying those things instead of gold for the reserve. Yeah, so they're just, that's a fact. It just is what it is. I think for 2023, the story to also watch is oil, because here's the thing. Normally, if we go into recession, and that's a big if, normally in recessions, oil prices contract, right? Because there's less productivity. However, in a 2000-ish kind of recession that's more mild and it was more of a hit to capital markets rather than the economy, maybe you don't get such a pullback in oil. Fundamentally, I believe oil has a story longer term and natural gas as well. And from the charts, from where oil bottomed, this is a pretty incredible structure right off the bottoms. So and this messiness here is indicative of more of a corrective wave. This is you can digest a big move like this either by declining or by buying time, and this is kind of a combination of the two. This is really a sign of buying time. The thing with oil is if you're going to get involved in it as an investor, there's these two green lines that I gave people. that's a support zone. That's a big wiggle room, and percentage-wise, it's a big room there. So oil can do a lot of things from going down to going up. So I keep telling everybody, I don't know where the next 5% move is, but I'm pretty sure I know where the next 50% move is. And I do think the next 50% over a year time frame throughout 2023 is probably higher prices. I don't want to scare the public on what my ultimate, if this turns out to be the case, I'm not going to put out there on video what I think our projection for a barrel of oil is in the future, but it's pretty sketchy, scary.
You have it up on the screen, and I was going to point that out. That
I have it on the screen.
Yeah,
damn
that
it!
That price is not this stock. That's one thing we should. We're not saying it's going to go from 30 to 250.
Yes,
that's the price per barrel.
Yeah, what's on the screen is just an exchange traded fund that attempts to track the price of oil, and it's not our suggestion of using for the proxy, but it gives you a good chart. Let's put it that way. So yeah, it's an interesting place to watch. I hope we're wrong, but we'll see.
Yeah, there's a lot of things that are affecting energy. A lot of things that are affecting energy more so than in the past. Yeah. So,
all right, we got to wrap this up, gentlemen. So the last thing is what's interesting is look at this. This is DBC. This is the food commodities. So this is all the companies that operate within soft commodities. And if you think about it, I'm going to go back. There's oil. See that chart? And look at this one. Don't they look incredibly similar? I mean, like, talk about correlation, right? And it's interesting because if you do think about it, if oil prices rise and transportation costs rise, your food costs are probably going to rise, right? So they have an interesting correlation. So there again, a lot of people would argue that, hey, how can commodity prices rise if we go into a recession? Depends on the type of recession, right? And so by the charts, this is really looking interesting that there's been this correlation between food commodities and oil. I've seen this before, so it's not a new phenomenon. I've seen this in decades ago, but it's happening, right? So that's why those are on the radar for 2023, because throughout the year, you're going to hear a lot more of us talking about it.
Do you think it could have a little bit of a headwind because if inflation starts to come down?
Yeah, that's the big key is I'm not even going to go through all this stuff. That's the big key is if there's a recession in front of us, how big is it? If it's what we've been thinking, a 2000 to 2002 style scenario where it's the equity markets, it's corporate bonds, it's where rich people took a little bit of a hit or capital markets took a little bit of a hit, but the overall economy, yes, it slowed down, but in 2000 to 2002, people weren't losing their jobs and moving back in with mom and dad. It wasn't like 2008. So we don't know, and we still don't know if there is a recession in front of us. We know that things are slowing down, but we're coming off this inflated pop out of the pandemic. So there's a lot for the economy and everything, figuring out where the new normal is. And I think in that kind of environment, it gives a lot of people cover, especially in energy and food. A lot of people gives them a lot of cover to push prices higher and make excuses of why that's happening in other places. So there's just a lot of factors there. But yeah, I think back to Justin's question is recession's the big key. Yeah.
One final thing I just want to point out is we didn't get a chance to get into all five asset classes, and it's just because there was so much going on in these ones that we've talked about the other asset classes in other videos. So if you're new to watching us, paying attention to us, there's an old adage that every journey begins with a step. So take that step and subscribe, watch our other videos so you can kind of get a sense of what we're thinking in some of those other asset classes, and you can stay up to date for any other videos that we do post on those classes.
Yeah. All right. Well, let's wrap it up because I think we've taken enough time for everybody. They want to get shopping and family time. I got my whole family at the house. My house is nuts. I got I got dogs, grandkids. There's so much going on. I almost don't want to go home. So I want to say to you two gentlemen, we had a hell of a year. We had a great friggin' year. And it could not have happened without the two of you gentlemen. I really appreciate all the support everything that we do together. It's been a fun year. It's been a successful year. Well, it's been challenging for a lot of other people. I look forward to 2023. I look forward to working more with you. And to all of you that are clients or thinking of becoming clients, I want to say to all of you, happy holidays. To our clients, we appreciate you more than anything. We do this for you, and we want to make sure that you always have a place that you can come to get honest answers about what's going on in your money life, because our whole goal is to make your life more easy and make the money part of your life more understandable so you're not in states of fear or concern. So with that, we wish all of you a happy new year, happy holidays, and take care, folks.
Take us out, Santa.
Yeah, see ya, Santa. Yeah, come on. Sing song.